The October 2024 World Economic Outlook paints a picture of a global economy that is steady but falls short of robust growth. The IMF has kept its 2024 and 2025 global growth projections at 3.2%, in line with previous forecasts from earlier in the year. Yet, beneath this stable facade, regional disparities reveal varied economic realities. While the United States has seen its growth prospects improve, several European economies have faced downgrades due to factors such as slowing industrial activity and energy concerns. Emerging markets and developing economies present a mixed outlook, with some regions experiencing, strong growth, particularly in Asia, while others grapple with challenges such as geopolitical tensions and commodity price fluctuations. Well, joining me to unpack this is Oladipo Ajayi, Head of Fixed Income and Forex at Chapel Hill Denham. Thank you for joining me today.
Good morning. Thank you very much for having me on this morning.
Right. Well, we see a projection of 3.2% for global growth. That's underwhelming anyway, to say the least. But what are your thoughts on this?
Well, I don't think it's something that is took me by surprise because when you look at the fact where we're coming from and post-COVID, it's been a tug of war globally. And just about the time that we're actually waiting that up, the crisis between Ukraine and Russia actually erupted. And since then, we've been seeing different unrest in different regions. And these are some of the things that have been put more like inflationary pressure on the global economy. And on the back of that, the monetary policy regulators of different countries need to actually maintain more like an hawkish stance. And we have seen the US Fed that's actually demonstrated that for close to 2 years. And also, it's not only peculiar to the United States. We saw the same thing in the Eurozone. We saw the same thing in UK. And for the first time in a long while, we saw Japan also toe the line some months ago. So it tells you that it's been a very heated global economy for the past 4 years. And we're just coming out of it. And now most developed nations are now moving closer to the benchmark inflation figure. And as a result of that, they are just removing their legs on the accelerator around that. Around the hawkish stance. So I don't expect any extraordinary growth for this year. So when the IMF mentioned that it's about 3.2 expectation, it's not something out of the box. But maybe my concern is for next year because they are still of the view that the growth rate will still repeat itself around 3.2. So I feel that we should have a better growth for next year because we expect the monetary policy guys to continue in their stride to actually losing the economy. And by so doing, that will actually be more like a growth catalyst that will help develop the global growth.
Well, let's disaggregate this now. Breaking it down, we see upgrades for the U.S., and this is expected to sort of impact other advanced economies. However, for the Middle East emerging markets, Middle East, Central Asia, and Sub-Saharan Africa, we see downward revisions due to disruptions to production and shipping of commodities, especially oil conflicts and all of those. We also see civil unrest and, extreme weather events. How challenging do you think this is, especially for Africa?
Well, it's a very challenging one. And when you look at the way it was broken down, the Sub-Saharan Africa is supposed to actually face more like still like an harsh economic stance. And sincerely speaking, it's not unconnected to the fact that there's still a lot of global tension. And also to the fact that this segment of the world is actually enriched with natural resources, and so it means that they are exposed to the volatility in the commodity market. We saw what is happening in between Israel, Palestine, Israel, Iran, Israel, Lebanon, and these are some of the things that will actually affect oil prices and also commodity prices globally. And the issue between Russia and Ukraine is still very much there. And because these Sub-Saharan Africa is more like dependent on natural resources for FX revenue. So it simply means that they are still exposed to that huge volatility in commodity price. So, and that's one of the reasons why they expect that segment of the global economy to actually continue, at least in the short to medium term, to continue to maintain upward stand. And if they continue to do that, it means that that will actually dampen growth. And so it means that when we are doing that, that will weigh down the weighted average of growth across board globally. And that's one of the reasons why they maintain that the sub-Saharan Africa will actually affect the global growth, which I also agree with. Let's take a clue from what's currently happening in Nigeria. Now, we are still battling inflationary pressure. It's not even a time that I want to start talking about growth. Ghana is just coming out of it. Egypt is still deep into it, you understand? So when we look at all these things, I think the only, some of the economy that we could say, oh, maybe they're already getting out is Kenya and South Africa. But when you look at Nigeria, Ghana, and Egypt, we are still deep into fighting inflationary pressure. So if we go by that, it simply means that they are not about growth now, they're about fighting inflation. And in such a time like that, it's not a time that you want to throw more like a losing monetary policy stand. And that will actually affect the weighted average growth globally. And I agree with what IMF said in that regard.
Well, talking about this, I mean, there have been a lot of conversations around how Africa sort of depends on primary commodities and that, and how this is usually affected by global shocks and external hostilities and what have you. But then can Africa shield itself, or better put, how can the continent sort of mitigate the impact of these risks? I mean, I know that sort of sounds like a long-term plan, but what can Africa really do? Is Africa even working towards it?
Well, sometimes in 2018, Africa came up with ACTA, that is African Continental Free Trade Agreement, where you can actually trade among yourself, and when you trade at free, and even sometimes you can get up to like 90% tax rebates on some of those things. And one of the reasons why that came up is to help strengthen African growth. Is to help actually ensure that trades are done among African countries. And I think as of April, we have moved to more like the operational stage of this agreement. But I think I would say that African Union is not doing great in this regard, because we should have expedited this thing beyond this level. We already have PAPS, which is more like the payment system created for this transaction. So what we need to do is to actually move to a full-blown operational activity. And I don't think we are actually pushing this aggressively, because if we are, we don't need to. It simply means that even if you are exporting natural resources to fellow African countries, it means that the same natural resources will actually be converted to finished goods within Africa client. And so it simply means that the benefits will still fall within the African zone. And that will also help to actually develop Africa as a nation. And just like what you said when you were asking the question, that we are so much reliant on natural resources. And we need to move beyond these natural resources into converting these into finished product. And it's alarming that Ghana will export cocoa, but we import beverage, we import chocolate. Nigeria will export crude oil, we import refined oil into the country, and so we have it. Ethiopia, we export coffee beans, and we import coffee into the country. These are something that we need to actually sit as a continent and look at how to actually take this thing beyond the natural state into more like a finished state. And that's one of the ways to go, and that's one of the ways to actually develop the Africa climate. We need to go beyond the natural resources to more like the finished, because what that would do is that in the process of converting the natural resources into finished product, what you would have done is that you would have created a lot of job opportunities. And by doing that, what that would do is further develop your economy. It would create growth. It will help to actually reduce the level of insecurity in your state, because your youth will be gainfully employed. And when you look at a continent that is so endowed with youthful population, I think Africa is actually operating below its capacity as we speak currently.
All right, I want us to pay attention to your emerging markets now because it's estimated that Africa contains 1/3 of the critical minerals needed for semiconductor manufacturing. Now, saying that the upgrades to the forecast for emerging Asia is actually based on surging demand, beg your pardon, for semiconductors and electronics driven by significant investments in artificial intelligence. Shouldn't this count for something for Africa, or better put, shouldn't the continent also be taking advantage of this, saying that, the primary minerals are actually from Africa, 1/3 of the primary minerals are from Africa. So if this is to the advantage of Asia, what happens to Africa?
Well, this is supposed to be a win-win, and sincerely speaking, because when you get to see information like this, it means that there's still a lot of opportunity for Africans. And I'm not surprised because that's why you see the United States, the Russians, the French guys, everybody in Africa trying to actually struggle and get a fair share of what is happening in the zone. And when you look at situations like this, what it simply means is that there's great opportunity for Africa. So what we need to do is that we need to start looking at a way to go into more agreement with most of these companies in the Asia zone. What we need to do, we need to go beyond exporting the raw material. We need to go into a way where you create an enabling environment for some of these companies to come and actually establish manufacturing company in Africa. Because what that would do is that it will help Africa beyond just selling the natural resources. It will take it beyond a notch higher than that into creating employment opportunity for people in Africa. It will also help to actually get more African youth actually engaged. So I feel that it's more like a win-win for Africa and the Asian zone. But what we need to do is that we should not just hold the line of just exporting the raw material to that zone. We should go beyond that into actually going into agreement and creating. Sometimes you need to actually put some incentives in place that will actually help some of these companies.
Apart from incentives, let me come in here. Apart from incentives, should we also start doing some protectionism or something? What do you think?
Well, one thing is that this is not peculiar to Africa. We only have 1/3 of it. The other parts of the world also have advantage around this thing as well. So that in as much that you are not capitalizing on it, you also need to find a way to actually create an enabling environment for those that actually done research and development around these things, and they are already taking it to the final stage. And another thing also is also give opportunity to companies in Africa that are actually looking at towing this line, because it gives them a better advantage because you are sitting on goods already. So what you need to just do is to actually capitalize on the already researched and products, and actually further do your own further research around it, and actually capitalize on that by actually creating a finished product around that. So I think.
All right, we're pressed for time. I'd like us to come to Nigeria now. We've been talking about Africa. I mean, charity they say begins from home. Now let's come to Nigeria. IMF lowered its 2024 growth forecast for Nigeria's economy to 2.9%, attributing the downgrade to, weaker than expected economic activity in the first half of the year. Talk to us about factors contributing to this and how significant this 0.2 percentage point downgrade, from the July 2024 growth forecast is for the country.
Well, what IMF said is more like it's an estimate. I still think that we'll still do very close, maybe about 3 or above 3%. And IMF decision is premised on what we have seen in the last 3 months, and increase in PMS prices. We saw an increase sometimes later July, and we saw another one also very close some weeks ago. So what that would mean is that it simply means that the monetary policy guys will actually maintain the hawkish stance. Before now, we are already anticipating that by the end of by November, we should start seeing the monetary policy guys changing their stance from more like extreme hawkish to more maybe like a mild or returning to a dovish stance. But what we saw sometimes some weeks ago, it simply means that they will continue to maintain this hawkish stance because they expect inflation to continue to rise. We saw this inflation in the month of July and August But based on the figure printed last week, we noticed a further increase in inflation figures, and simply means that we are still back on the same track that we have been fighting. And what this will mean is that the policy of the monetary policy guide will continue to hamper growth. And that's one of the reasons why IMF actually maintained that there will be a reduction in growth beyond what they have actually anticipated as a July. But I think that we'll still actually eat around 3% despite all these things.
Well, talking about this, we know that global battle against inflation is actually believed, beg your pardon, to be almost won. And IMF has said that a policy triple pivot is actually needed. Now, what's the outlook for Nigeria, and what would you say it is doing? Would you say it is doing well on the three-pronged approach? That's whether you're talking about, the three, whether it's structural reforms, fiscal policies, and monetary policies. How well is Nigeria using these three to actually address this issue?
Well, I think on monetary policy, the country is doing very well. The monetary policy guys, they are actually proactive and they've been very hawkish. Of course, a lot of us criticized that decision in the month of September, but in retrospect, when you see what happened with inflation, a couple of the five decisions to actually remove fuel subsidy fully and the impact on prices. Of course, we feel that they actually they are able to see ahead, and that's one of the reasons why they took that plan. So for them, I think they're actually doing very well. And when you are looking on the aspect of the fiscal policy guys, I think they need to double up. And my concern with them is that they be more reactionary than proactive. And you don't wait for situation to occur before you actually look for solutions. You must be able to preempt. And that's one of the things that the monetary policy guys are doing very well. So I think the fiscal policy guy needs to double up around that. They need to do more. You need to find a way to diversify the economy. We can't be only reliant on the oil sector. So it simply means that we are exposed to the volatility of the commodity market. So we need to look at beyond that. We need to further develop our manufacturing sector. You need to find a way to incentivize that. You need to further develop the agricultural sector. And these are some of the things that we need to do in terms of the fiscal policy gap. But on the reforms, part of the reforms, I think the government is doing a bit, but I think that they need to speed that up because when you hear lofty idea, more like the tax reform and some other reforms that the government is currently putting in place, I think they are lofty ones, but it's just something that they need to do very fast. At times, on their side, and you don't allow a reform to linger too long, or else it will lose its essence. And I think that's where we're actually dropping the ball in terms of some of the reforms. But in summary, I would say that it's fair. I won't say we are doing so good because the fiscal policy guys are not doing extraordinary well beyond my expectations. So I would say we are just fair. I won't say we are good currently.
All right, I would have loved to take you on structural reforms, but we don't have that time. Maybe some other time. Thank you so much for your time. Oladipo Ajayi, Head, Fixed Income and Forex, Chapel Hill Denham.
You're welcome. Thank you very much for having me on.